Hello, everyone. This is Anton Madley with Peak Market Watch. I'm together here with my colleague John Martinez. Hi, John.
Hey Anton, how are you?
Good yourself. Uh,
Doing well.
just just wanted to quickly jump in and discuss the Fed hike 2 days ago and what our take is on this. So why don't we quickly share their official statement here that they always issue. Uh, Obviously, they are still talking about economic activity as being expanding at a modest pace. Uh, Probably not everyone will agree with that, but at least that's when you strictly look at the number and have a look back uh, uh, approach to it, then that's certainly true. Job gains have been robust. With today's numbers, that's definitely the case. And inflation continues to remain elevated. So nothing new there. Interesting the statement the US banking system is sound and resilient. Uh, that one certainly can argue whether that is the case or not. But they also acknowledged tighter credit conditions for household and businesses are likely to weigh on economic activity, hiring, and inflation. But again, they don't really know. They don't have a crystal ball, as nobody does. So the extent of these effects remains uncertain. And so, but still, one of the core messages: the committee remains highly attentive to inflation risk. Because I think this is the core element. And when whoever listened also to the press conference, that's definitely still the core focus, and that has been now a core focus for the last year since they started hiking pretty aggressively. So no surprise, they raised it by another quarter point now to the target of 5 and 5 and a quarter. Uh, and also mentioned, as already they did in the previous meetings, they will continue reducing the holdings of Treasury securities, agency debt, and agency mortgage-backed securities. Uh, that seems to be the case, but then again, they toss in liquidity in other directions to support the banking system. So you tighten on one hand, but then they provide more liquidity on the other side, right? So
Right.
so what's your take on all of this, John?
Well, I don't think we saw a surprise as far as the rate increase is concerned. My thought is, as outlined and kind of roadmap by the Fed, they keep looking at what's going on with jobs, how tight is the labor market, are we continuing to see pressure with regard to the cost of labor, and I'm sure other inflationary items. So like you mentioned today, you had a strong labor print from the Bureau of Labor Statistics. And I think folks are still kind of trying to figure out how much of that information that's coming is a little bit of window dressing to make sure that the Bureau of Labor Statistics can support the current administration. Because if you look a little bit into additional numbers around today's release, you would find that there were meaningful revisions to the historical data for the months of, I believe, February, March. So, as you're probably, I'm sure, well aware, when the Bureau of Labor Statistics puts out where it sees the job growth, it's part survey, part model. So, I'm not saying it's a complete goal seek function, but it feels as if there is a fair amount of discretion. And if the Fed's using that as part of their feedback loop, I think we kind of have to also keep an eye on, well, what are the prior revisions? Because I think that'll inform some way as people watch that information, how it's getting revised, whether or not the Fed is getting closer to needing to cut. So the headline looks like no cut immediately, but underneath, when you start looking under the hood and seeing what are the trailing revisions, I think that maybe gives you a closer handle on whether or not the Fed's going to have to come off the gas and maybe make a cut sooner than expected.
Yeah, it's a good point, right? I think really the key message when you at least listen to him during the press conference is that they just do not know, right? So they see labor extremely tight, right? And that was one of his statements again during the press conference. Inflation remains well above the 2% mark. So these are the two pieces that are obviously a major concern. I think throughout the press conference, he outlined multiple times it takes time, right? And he also mentioned in various words that also the credit tightening obviously has an impact, but the credit tightening on its own, just because we have that happening now, is not really a reason for them to start cutting until they see a clear trend, right?
Yeah.
I think obviously they have realized that they misjudged the run-up of the inflation significantly, and I think they, at least at this point, unless there is a severe distress in the economy, and they certainly do not see the bank situation we have gone through as an ongoing stress. So as long as that is not the case, they do really feel that they need to cut rates in a very quick fashion. Whether that is ultimately happening or not, we will see, right? But at least so far, at least they haven't really felt the need for that, right?
Yeah.
So now, obviously, they also talked about the debt ceiling. I think he made it very clear, look, the debt ceiling is not up to us. That's a different branch, but at the same time, it's obviously crucial that we come to a solution there, right? So I would say that is obviously a key piece. But I think what I found very interesting, that with one of the questions that he was answering, he was also referring to that the tools they have in place, he feels that they are not in conflict, and this is right. I think we have found that the monetary policy tools and the financial stability tools are not in conflict, and that is kind of interesting that he made that comment. I'm not sure that that is really the case, but at least that's his worldview, right?
Yeah.
And it's the financial stability of the system. I think he mentioned it also. Well, it's the FDIC that has to deal with any bank failure and how they deal with it. It was interesting that he also mentioned that, at least from his point of view, he likes the fact that we have a combination of banks, from the large banks to small banks to regional banks to credit unions. But I think he also acknowledged that the banking sector has shrunk significantly over the years, right?
Correct.
And but at the same time, it's whenever the FDIC decides, look, we have a problem, it is up to them to find a solution. And obviously, the most recent one with JP Morgan gobbling up another bank is essentially his view. Look, the law requires find a solution that is the least costly, and that JP Morgan stepping in apparently was the least costly, right?
Yeah.
I'm not sure that it's a long-term solution to this, because again, we create larger and larger institutions that ultimately are becoming more of a systemic risk, right?
Yeah. And well, I would just add a quick comment, Anton. Being at an event last evening here in Houston, with investors as well, folks asking, kind of just kicking around the question of, when I share with them, that have looked at banks in the past and from an equity research perspective, and their just general question is like, what's my opinion? Are we going to see more failures? You get that sense that, at the investor level, for what we do, people are very aware, they're very watchful. That's one instance, right? And this morning here in Houston, visiting with family, had a service provider come out and service the family home, and I happen to recall and know that the individual that came out was the business owner. And, we're chatting and he's asking the same question. So, with, relatively, sophisticated investors as well as small business owners, it's still top of mind, the concern of, either what's going to happen with my deposits or what is the cost of borrowing at the business level. So, it's very topical, at a very broad level. I think it's very top of mind, and it's one thing for the Fed to have I think a good handle of the theoretical impacts, and they very well may be right, but it's interesting to see it just be so pervasive that as simple as someone coming to service our home, the business owner is asking like, well, what do you think? Are we going to see more bank failures? And may not impact in any way his business. As the deposits, I'm sure, are fine, and the immediate credit he needs is fine, but it weighs and is being judged in people's business decisions.
Yeah, absolutely. Right. And I mean, there is no doubt, as you know, right, we have seen it on the real estate side. Banks have been cutting back with their lending activity tremendously. Unless you're an existing client, it's very hard to get new projects financed on the commercial real estate side, at least. Ground up developments are much harder to finance as a result of that. In the past, banks were willing to participate in other banks' deals. That's not going to happen anymore. And so how are these larger construction loans being financed when banks are no longer willing to participate in other banks' deals that originate a larger construction? So now we are relegated to the life insurance companies for the larger deals. So the institutionals are probably fine, but particularly the middle markets, real estate construction borrower definitely is suffering here. Yes, there are private lenders out there, there are debt funds out there, but their terms and conditions are just not as attractive, generally speaking, as what banks are offering, right? And unfortunately, right now it's pretty tough, right? So the reality is Powell acknowledges this, right? That the credit tightening has a significant impact. But it sounds, at least as it is right now, it sounds like he and the committee are okay with it because they want to see a slowdown of the economic activity. And obviously, they don't know when the pendulum is going to shift, and they can start to loosen up. But I think their messaging right now is labor is still very strong. The economy overall is still pretty strong. Inflation is still too high. And until we see a positive trend towards that target 2%, we are sticking to our guns, right? So let's see whether for how much longer. I think my view has, as you know, has always been inflation is going to be much more sticky because of structural changes, primarily because of COVID and the impact it has had on the overall supply chain, and re-onshoring, that it will take so much longer to get inflation under control. But there are others out there that claim that by the end of next year we are down to zero again with the Fed rate, right? So so they are obviously, I don't know whether it's clickbaiting just to get some news there with these statements, but very clearly some have that strong belief. I still do not believe that we are getting there, and if we do, then we are in a very difficult situation where we likely have a almost a stagflationary environment, which we definitely don't want to face. Right?
Yeah, agree. And yeah, I think you're right. I think that there's, structural components that, will likely make some of this inflation, we just won't be able to maybe turn back some of it. And I don't want to delay, but just in visiting with the gentleman last night, business owner, multiple small businesses, one of which oddly happened to be manufacturing in Europe, sourcing materials out of Russia, and just visiting with him about that. And clearly his business model had to adjust here in the last year plus. But I asked him, like, what do you think? Do you think that things are going to change? And he said, yeah, we've had to, luckily there's enough margin, they could source materials elsewhere and still have a good business. But his overall view was that, there's just some things that aren't going back. And I think that, again, anecdotal, but it just nails on the point of what you're saying, that there are some things in our business environment, while we're looking at real estate here in the U.S., but it's just the larger concerns that we're in a different environment. Post-COVID, different supply chain issues that persist, as well as what might be going on at a global level that still do impact our cost of business here in the U.S. and have upward pressure on prices, or make it, like you said, sticky.
Yeah, definitely. All right, so
Sounds good.
Guys, let us know what you think, whether you believe some of these economists and others that believe we'll be down to zero Fed rate by the end of next year, or whether you are more in our camp, where believe that inflation is more sticky and rates will likely be stay elevated. Remember, even if we have a cut of, let's say, 1% over the next few months, or let's say by the end of the year, it's still elevated, right? So, and it still will have a pretty significant impact on lending. It has an impact on all the bridge loans that need to refinance. Obviously, we don't know yet where the 10-year Treasury is going to be in 6 months to 12 months from now. I'm not that hopeful that we will see it below the 3% mark, if at all. But some believe that we will be down well into the 2s, right? Or even below that. I just don't see that. So what I would recommend, look, if that all pencils out and works out that way, great, but don't assume that it's going to happen, right? And if you have a capital event, don't think that it's smart just to wait for another 6 to 12 months and then you're against the wall, because we do not know whether when the next banking crisis and liquidity crisis and credit crunch that comes with it is tightening even further. And that's the last time we want to be in a lending environment as a borrower. Right. All right. So thanks, Sean, for jumping on.
Thanks, Anton.
Everyone, have a nice weekend, and hopefully we will have some updated news the next couple of days and weeks. Talk to you guys soon. Bye-bye.